past month has been a particularly unsettling time for the global economy as the coronavirus spread rapidly across China. While the actions of authorities look to have largely quarantined the virus within China, the economic effect is rippling out. Until the virus is contained, this shock will persist. In the SARS outbreak of 2003, the singular historic comparison we have for coronavirus, annualised Chinese GDP growth fell sharply from 12% in the March quarter to just 4% in the June quarter, and then it rebounded. In 2020, an even greater proportional shock to China's GDP growth is likely. The primary reason this is the case is that the coronavirus outbreak of 2020 occurred over the Lunar New Year holiday period, the peak time of year for Chinese consumer spending and travel. The coronavirus has also required much stricter quarantine protocols due to its highly infectious nature, and as the epicentre of the virus, Wuhan is a major production and transportation hub. Note also that China carried much less momentum into this outbreak, China GDP growth having halved between 2003 and end 2019. For these reasons, we expect GDP growth to stall in the 3 months to March. Assuming containment is achieved by the end of the quarter, annual growth in 2020 is likely to come in at around 5.3%. This is half a percentage point below our previous forecast and almost a full percentage point below 2019's gain. A shock of this size to China's economy would take around 0.1 percentage points off world growth. Spillover effects in neighbouring nations will take another 0.1 off, reducing 2020 world growth to just 2.8% on our estimates. What exactly are these spillovers? Essentially, they stem from global trade and travel. For manufacturing, the loss of component supply from one country can quickly put an indefinite halt to assembly operations in another. As an example, Hyundai just announced suspension of car production in South Korea because parts produced in China can no longer be sourced. The service sector of many nations is also heavily exposed to Chinese demand after rapid growth in outbound tourism from China over the past decade. In East Asia, tourists from China make up a very significant share of total arrivals and spending. For a nation such as Thailand, who currently has the highest number of coronavirus cases anywhere outside of China, the additional risk is that they not only lose tourists from China for an extended period, but also from other nations as fear builds. For Australia, the restrictions imposed by both the Chinese government and our own to combat the coronavirus guarantees a shock to growth while the virus is active. This is not only because of the loss of tourism, but also because many students due to come here are no longer allowed to travel until the outbreak is contained. Incorporating a temporary loss of exports into the March quarter, as well as a longer-lasting hit to business investment and household consumption, we believe that the coronavirus outbreak is likely to reduce 2020 annual GDP growth in Australia to just 1.9%. This is a stark contrast to the 2.75% expectation of the RBA. It goes without saying that the balance of risk for coronavirus are heavily skewed to the downside. If the outbreak persists past March, then the shock to growth globally and in Australia could become materially larger than the base case we have described here. See you next week.